So our next question comes from Garrett. Garrett says, "Hey guys, my name's Garrett. I'm 37, married, and I have 3 kids. I work as a general manager for a fast food restaurant, making roughly $145,000 a year before taxes. My wife makes $90,000 a year before taxes, so our household income is $235,000 a year pre-tax. We make good money, but I can't help but to feel behind. I want to retire at 55 years old, but I feel like I'm never going to get there. The breakdown of our finances are as follows. We have and maintain $10,000 in our checking account. We have $40,500 in a joint brokerage account. We each have a Roth IRA with $28,000 in it. And now the ugly part is we have a mortgage with a very low interest rate, and I'm in no rush to pay that off, but we do have a HELOC that we used to pay off high interest vehicle loans and credit card debt. The total for the HELOC is $175,000. That is all of our debt. We've been pushing anywhere between $6,000 to $10,000 a month toward the HELOC in hopes of knocking that out as soon as possible. And then after we pay off the HELOC, the plan was to use that same amount of money, catch up on our investments, and hopefully retire early. Am I way out of left field thinking I could possibly retire early? Thank you all so much for the help. Love your podcast." Garrett, thank you so much for listening to the show. We are super grateful that you listen to our show, and so many of you do. It's really awesome. So you guys make $250,000 a year, and you're broke. That's the reality, right? We make $235,000 a year before taxes, about, I'd call it $14,000 a month after taxes, so about $170,000 a year. And you guys have, let's call it, about $100,000 invested. Now, that's not a bad sum of money by any stretch of the imagination. Congratulations on getting $100,000 invested by 37. But man, what went wrong? Maybe you guys recently started earning this much money. Maybe you guys were in a very different situation up until a couple months or a couple years ago, which is why you have all this high interest vehicle loans and credit card debt that was, the HELOC and things like that. Maybe you guys were in a completely different situation, but maybe you weren't. Maybe you've been high earners for all of your 30s and you guys just swiped the credit card and said, what's the payment, right? What's the phrase? I think the phrase goes, broke people ask, what's the payment? Rich people ask, what's the amount? Right? So it's like, what's that monthly payment? How can we fit it into the budget? Is it going to work? What are we going to figure this out? So here's what I would do. If you guys are actually trying to retire early, and you actually can put aside, let's call it $8,000 a month, $7,000 or $8,000 a month toward this HELOC, that's $175,000 divided by $7,000 is 25 months. So let's call it 2 years. So in 2 years of putting $7,000 a month toward this HELOC, you will have it paid off. So that's what I would do. I would spend the next 2 years putting $7,000 a month toward this HELOC, which is likely at 8.5% to 9.5% interest, which Robert and I would classify as high interest debt. You're not going to be able to invest that. So it makes more sense to really aggressively pay it off. However, during that period of time, Robert and I talked about this beforehand, you don't want to stop investing toward the Roth IRA. You want to continually to max out that Roth IRA for you and your wife, which will be about $1,000 a month, which gets you at $8,000 now of that $14,000 a month that you are taking home every month is getting invested to the Roth and using to pay off the HELOC. So you're going to live off of $6,000 a month. You're going to be fine. You're going to survive, right? $6,000 a month is a ton of money. That's how I'd approach this. And then now you're 39 years old. You guys have $100,000 invested. You want to retire by 55. So let's run some numbers. So 39, 55 is when we want to retire here. You already have $100,000 invested. You're going to be contributing, let's say you just continue to max out your Roth IRAs every month and your average returns 10%. So at 55, you'll have about $1 million, which hard to retire off of $1 million with 3 kids. But the good news is by 65, that turns into $3 million. That is a healthy retirement. So maybe there's a world where you do retire early and you guys get really aggressive on this investing stuff. And, who knows, right? I think you said you want to take that $7,000 a month and toss that toward investing, right? You did that correctly. You'd really be able to have more than $1 million by 55. But it really comes down to behavior. I mean, you guys got yourself in this mess and I'm optimistic you can get out of it. But you got in a mess to begin with. And sometimes you got some scar tissue that rolls over. And I don't know. I'm wishing you guys the best, but I'm eager to hear what Robert thinks.
This question in this situation really is all about what we discussed earlier, and that is people just keep buying stuff. They have to have the 2 new cars. They have to have the new iPhones. They have to have the new iPads, the big screen TVs, the jet skis, whatever it is. And this is a perfect situation where we have a high earning couple, $250,000 a year, yet they have high interest debt. And that just doesn't make sense to me. And so I think it is some tough love, but the good thing, because they're high earners, they can fix this. I agree 100% with you that I would have a really, really tough love conversation with the family. I'd sit everyone down and say, we're going to make some changes, and here's why. It's short term, but we're going to fix this together and get everyone to understand we can't go out to eat 5 nights a week. We can't be door dashing. We can't be doing all of this because we have to chunk away on this debt as fast as possible. And if you want to retire early and enjoy your kids and have a wonderful life, you can do it, but you have to do the hard work now over the next 2 or 3 years. And I think, Austin, your plan that you laid out is perfect. Keep maxing out the Roth because we want to make sure we have that after-tax money towards retirement that's ready to rock and roll later on. But then the rest of it has to go to get rid of this. But in the meantime, you can't take on more high-interest debt because you're chunking away at the HELOC, because then it's going to be a perpetual cycle that you have to break. And this is for everyone listening. That is why we have the emergency fund, and that is why we have a debt to income ratio and a budget, so you don't live beyond your means. Just because you have credit does not mean you should always be using it to buy things that are going to depreciate and that you don't need. I don't even have a new iPhone. I have the 15 Pro Max and the 15 Pro. I could go get a new iPhone tomorrow and get 2 new ones and upgrade. But why? These work perfectly fine. And I think this is something that is mostly mindset for people to get over and be able to overcome in their lives, because you want to be able to build towards that lovely, financially free retirement. The earlier you can start it, the better off. So I think this is a fixable situation. We're sorry for the tough love, but we want to make sure you understand how to fix it and the right way to do it.
So really, really wishing you luck, Garrett. We really think you can get out of this situation. I truly believe that you are going to fast forward 20 years and thank yourself for all the hard work you put in when you were in your 30s and 40s, and you will be able to retire early. It just comes down to making the conscious decision of, am I going to continue to live beyond my means? And am I going to continue to want to keep up with the Joneses, or high interest this, credit card debt that? You got to just say, I'm not doing that anymore. I make $14,000 a month. I'm going to pay off this HELOC. I'm going to invest in my Roth IRA. And then 2 years in the future, we're going to live off of 6, 7, 8,000 of that 14, and the rest is going to get invested. And you do that, you will have a couple $1,000,000 by 55. But you got to make sure, and this is not just for Garrett, because I know there's 100 Garretts listening right now that are in this situation of, hey, I'm in my 30s or my 40s, and I lived beyond my means for a lot of my life, and now I'm trying to catch up, and I got to feel like I got to make some sacrifices. It's possible. It's absolutely possible. You just need to have the path forward and understand the steps to take. And I hope that you are able to listen and learn from what our answers were for Garrett here. And don't forget, you cannot out invest high interest debt.